Today, governments aren't just reviewing the investment, they are trying to identify who ultimately controls it before it reaches critical industries. In this video, we'll explore why governments around the world have checking foreign investments more carefully, how these reviews work, and why protecting strategic technologies from suspicious investments has become one of the biggest national security priorities of our time. A $5 billion investment. One signature, one government review. Everything looked perfectly legal. But investigators weren't looking at the company listed on the documents. They were looking for the person behind it. Because in today's world, the biggest question isn't where the money comes from. It's who's really behind it. For decades, countries around the world welcomed foreign investment. Like every major economy, they relied on global businesses to fuel growth. Companies built factories, created jobs, funded research, introduced new technologies, and helped strengthen economies around the world. Because under normal circumstances, investment is a good sign. It means businesses believe in a country's future. Now the world had changed. 20 years ago, identifying an investor who investment money was relatively simple. A company submitted an investment, the government reviewed it. If everything checked out, the deal moved forward. But today's global economy doesn't work that way anymore. Large corporations rarely operate through a single company. Instead, they are built like networks. One company manages finances, another owns patents, another holds investments, another operates in a different country. Together, they function as one business. On paper, they appear as completely separate companies. Imagine looking at a tree. Above the ground, you only see the trunk, but underneath, hundreds of roots spread in different directions. Modern corporate ownership works much the same way. What you see on the investment application may only be the visible part of a much larger structure. Before reaching its destination, an investment might pass through holding companies, regional subsidiaries, investment funds, or international financial centers. Each step is perfectly legal. Each company has its own registration, its own directors, yet every additional layer makes one thing harder to answer. Who is actually making the decisions after investment? Because ownership and control are not always the same. Let's follow the money. Foreign investor, holding company, investment fund, shell company, trust, technology company, ultimate beneficial owner, government investigation. On paper, every company looks independent, but follow the ownership chain, and one decision maker may still control the entire investment, because that's where the real investigation begins. Imagine you are sitting inside a government investment review office. For years, the investment review system worked exactly as intended. A foreign investor submitted an application. Regulators verified the required documents. If everything satisfied the legal requirements, the investment moved forward. It was a system built for a much simpler world. But today, global business didn't stay simple. Globalization changed the everythings. As multinational companies expanded across borders, they no longer operated through a single company. They became networks. A parent company, regional subsidiaries, holding companies, investment funds. One investment, hidden behind layers of ownership, by the time the investment reached the review process. The name on the application no longer told the whole story. That exposed a gap in the existing review system. It couldn't identify the investor, the person ultimately controlling the investment. Now just see to the artificial intelligence, semiconductors, quantum computing, advanced robotics, next-generation communications. These are not just growing industries anymore. They were becoming the foundation of economic power for country, scientific leadership, and national security. Suddenly, buying into a technology company wasn't just a financial decision. It could also mean outsiders gaining access to research, engineering talent, critical intellectual property, or technologies that governments considered strategically important. The investment hadn't changed. Its importance had changed. And that was a dangerous loophole of investment. That wasn't just an investment risk anymore. It had become sometimes a national security concern. So that's why the review process itself had to change. Today, global foreign direct investment is measured in trillions of dollars every year. Most of it supports economic growth, but as more investment flows into critical technologies, governments have begun asking much deeper questions about ownership and control. Main question is that, how do you stay open for global investment without losing visibility over who ultimately controls your most important industries of the country? Finding that answer meant looking beyond the company listed on the application and following the ownership trail itself, because that's where the real investigation begins. But today, governments look beyond the paperwork. Instead of checking only whether an investment is legal, authorities investigate much broader question. Could this investment create national security risks in the future? Imagine allowing an investment into a company developing next-generation semiconductor technology. Nothing unusual happens on day one. Nothing unusual happens on day 100, but 5 years later, that technology becomes essential to AI systems used around the world. Suddenly, a business decision made years earlier looks very different. Governments wanted to evaluate those risks before they became problems. That's why governments began introducing new investment screening frameworks that gave authorities more time, more information, and greater flexibility during the review process. Instead of treating every investment exactly the same, authorities can take a closer look when sensitive technologies are involved. Not because every investor represents a threat, but because every strategic investment deserves a deeper understanding. Think of airport security. Millions of people travel every day. Most passengers are completely ordinary, yet security checks still exist. Not because everyone is dangerous, but because the consequences of missing one serious risk can be enormous. Many governments believe investment screening works in a similar way. Of course, not everyone agrees with stricter investment screening. Some businesses argue that longer reviews can delay investment, slow innovation, and create uncertainty for global companies. Governments respond that protecting critical technologies outweighs those costs. Most foreign investment remains valuable. Most investors follow the rules. Most businesses simply want to grow. But when an investment reaches industries considered strategically important, the level of scrutiny changes. Authorities may request additional information, review ownership structures more carefully, examine who has decision-making authority, or study whether the investment could create long-term security concerns. Sometimes, the review ends exactly where it began. The investment moves forward. Nothing changes. Other times, authorities may approve the investment with specific conditions designed to protect sensitive technology. And in situations where officials believe the risks cannot be managed, the investment can be blocked. Notice what changed. The focus isn't on stopping foreign investment. The focus is on understanding it. Governments aren't trying to close their economies. They're trying to make sure they know exactly who is investing in their most sensitive industries and why. Because in today's world, money doesn't only build businesses, it can also create access, influence, partnerships, information, and sometimes, strategic advantages that last for decades. That's why many governments now believe the first line of defense isn't built around factories or military bases. It's built around decisions. The decision to ask one more question. The decision to investigate one layer deeper. The decision to understand who ultimately controls an investment before it's too late. But no country was making these changes in isolation. As governments studied the global landscape, they noticed something surprising. Other major economies were beginning to ask the very same questions, and suddenly, this was no longer one country's story, it had become part of a much larger global shift. We can see rules, regulations already around the world. The United States strengthened its foreign investment review process by expanding CFIUs in 2018, giving authorities broader powers to review and even block investments that could threaten national security. In 2021, the United Kingdom introduced the National Security and Investment Act, allowing the government to scrutinize investments across 17 sensitive sectors and intervene whenever national security is at risk. Between 2020 and 2021, Germany expanded its foreign investment screening rules, enabling the government to review acquisitions involving critical technologies and strategic infrastructure. We can see some examples related it. Germany, in 2016, Chinese appliance manufacturer Midea acquired KUKA, one of Germany's leading robotics companies. Although the deal was approved, it sparked nationwide debate over foreign ownership of advanced technology. The concerns that followed later influenced Germany's decision to strengthen its investment screening rules. United States, in 2018. The U.S. government blocked Broadcom's proposed acquisition of Qualcomm. Officials warned that losing leadership in next-generation semiconductor technology could create long-term national security risks. Australia, in 2016. Australia blocked the sale of Ausgrid, one of the country's largest electricity network operators, citing national security concerns over critical infrastructure. Canada, in 2022. Canada ordered several foreign investors to divest from critical minerals companies, arguing that control over strategic resources had become a national security issue. Around the world, governments began to realize that technology was no longer just an economic asset. One realization began to spread. Technology wasn't just driving economic growth anymore. It was becoming a matter of national security. The companies developing the world's most advanced chips, building next-generation AI, designing quantum computers, or managing critical communications networks, were no longer seen as ordinary businesses. They were becoming strategic assets. Assets that could influence economic strength, supply chain resilience, scientific leadership, and long-term competitiveness. That changed the conversation. For decades, countries mainly asked a simple question. Will this investment create jobs today? Another question sits beside it. Could this investment may create long-term strategic risks? That doesn't mean foreign investment suddenly became unwanted. Modern economies still depend on international capital. Innovation still depends on global partnerships. Businesses still invest across borders every single day. The challenge is simple. How do you remain open to investment while also protecting technologies that may become critical in the future? The answer wasn't to close the door. It was to look more carefully at who was walking through it. That idea reflects a broader shift taking place across many advanced economies. Governments are paying closer attention to investments involving sensitive technologies, not because every deal is suspicious, but because the value of these technologies has changed. AI is transforming industries. Advanced chips power everything from smartphones to data centers. Quantum research could reshape computing. Critical infrastructure has become more connected than ever before. And when technologies become this important, governments naturally become more cautious about how influence over them is acquired. Seen from that perspective, these new investment screening rules are about much more than paperwork. They are about adapting to a world where ownership structures have become more complex. Technology has become more valuable, and the consequences of overlooking hidden control have become much greater, which brings us back to the question we started with. So why would a government pause the process? Because appearances are only the beginning. Governments want to understand the full story behind every investment that reaches their most sensitive industries. Not just the company signing the documents, but the people making the decisions. Not just where the money comes from, but who ultimately controls it. That single shift in thinking explains why the rules changed, and perhaps it also reflects something much bigger. In the past, economic power was often measured by factories, trade, and financial markets. Today, it is increasingly measured by control over the technologies that will shape the future. And in that world, knowing who is really behind the money is no longer just a financial question. For governments around the world, it has become a national security question. Factories can be rebuilt, money can be replaced, but once control over strategic technology is lost, some advantages may never return. That's why governments no longer ask only where the money comes from. They ask one final question: who's really behind the money? This documentary explains how modern investment screening systems work around the world. It does not suggest that foreign investment is inherently harmful. The vast majority of international investment is legitimate and remains essential for economic growth. Thanks for watching. Do subscribe for upcoming videos.